The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. Stock markets in Europe and the United States close off their best quarter since 2020, with, you guessed it, tech and AI driving gains, whilst energy buckles. That, though, amid uncertainty in the Middle East.
Inflation across the Eurozone's major economies slows in June, giving central bankers in Sintra some respite. Meanwhile, Bank of England Governor Andrew Bailey tells CNBC there's one key reason behind the recent pickup in prices.
Actually, I believe even more now. I've seen the data over the last couple of months that we would have been back at our 2.0 target around about April, May time. So the fact that we aren't is hugely frustrating.
Is it all because of the war?
I think so, yeah. Attention
today turns to CNBC's headline panel and closely watch comments from new Fed Chairman Kevin Warsh.
US envoys Steve Witkoff and Jared Kushner arrive in Doha, but direct talks with Iran appear to be off the table for now. Meanwhile, Iran claims it is now selling oil at a 20% premium since the Strait of Hormuz reopened.
We watched the quarter play out in real time, and there's no doubt there was huge AI fever across those many weeks. We saw the rolling appetite for semiconductors, and it was really just the back end of the quarter where some of the euphoria came unstuck. Take a look at what we saw over the course of some of the trade, and this is a look at the Dow in session yesterday, about 0.25% to the upside. The S&P and the Nasdaq tech stocks, as we saw the final window dressing, really just bouncing back, and you can see it very evident in that trade. But over the course of the quarter, this is where it got interesting. Very firm trade on the Nasdaq, in particular. That tech dominance really demonstrated in the quarterly figures. At the extent of it, 21% for the Nasdaq versus those gains of 14%, still decent for the S&P 500, and 12% for the Dow. So no complaints about the performance in the round, but if you wanted the supersized returns, very much contained to the tech-heavy Nasdaq stateside. And similar story across from the Asian markets. It was the Kospi. Real standout. We saw that play out as we're talking about record after record, and the likes of SK Hynix overtaking Samsung as the most dominant stock in South Korea, but very much those two DRAM players fighting it out for dominance and carrying the Kospi to that 67% gain over the quarter. We saw, Japanese stocks too, record highs inked in that time, 37% firmer in the quarter, very much outpacing other areas in the region. And in fact, China stocks, a lot of questions around China tech and just how to monetize, down to the tune of just over 7.5% for Hong Kong stocks. China securities, the Shanghai market, up to the tune of 5.2%. So very wide performance, you'd have to say, over the second quarter, Ben.
Yeah, and positive quarter for the European markets as well. Not quite the sort of gains that we saw in Asia and the United States on those benchmarks, but notching up positive end to the second quarter as well. The Italian MIB, the outstanding performer, up 16% in those 3 months. The Pan-European Stock 600 averaging 10%, just slightly over 10% gain for that quarter. The DAX 10% higher. The FTSE, the one that was slightly lagging behind, up 3.15% on the quarter, of course, reflecting perhaps the drop in the oil and gas price that we saw and the impact that has on the oil and gas majors. But that is the picture as Europe ends the second quarter of the year. Let's just take a little bit of a deeper dive into that, because European equities may have notched their best quarter in over half a decade, but some sectors took a beating. As I mentioned, oil and gas fielding the most of the blows. Shares in BP and Shell both sustained heavy losses as oil prices plunged, with BP the worst performing stock on the UK's benchmark FTSE 100. The index's exposure to the energy sector saw it underperform the wider European benchmark in the 3 months from April, just as it has since the country voted for Brexit, which saw its 10th anniversary last month. Autos also underperformed in the second quarter, hit by energy price volatility as well as rising competition out of China, with Stellantis' Italian listing the worst performing stock in Europe in the first half of this year. Now, on the positive side, guess what? The AI boom led European tech names to their best quarter since October 2001, even outperforming their American peers.
Right, where do we want to start on this one as well? I tell you what, I'll play the bear. Now,
Well, that's not a fun position after
well,
the quarter.
no, but it's kind of somewhere I feel more comfortable with current valuations. I'll play the grumpy old man here as well. Are we in overvaluation territory? Are we at the point where we are 1906, 2006, 1928, 1999? Are we that year before it all goes bust on those similar occasions? And the answer is, I don't know. And actually, given the vast amount of money that institutions and retail investors still have to put into the market, I mean, there is some evidence that there is trillions of dollars available to absorb all this hyperscaler money, to absorb this capex as well, these extra bond issues, this re-equitization, because we've done with de-equitization, certainly for the hyperscalers as well. Can the market sustain more? And an old smarty pants who comes on this show, and we love him dearly, is Ian Harnett from Absolute Strategy. And he's written a very good op-ed, actually, in the FT, talking about the actual valuations and then talking about what kills bull markets. So I'll just do that very quickly. The actual valuations at the moment are historically very challenging for the bull market. Again, I'm just playing a role here. So we are trading at 28.4 times trailing earnings. 28.4. That is 40% above the 40-year average. We are trading on a cyclically adjusted basis, and we all know Mr. Schiller, the Cape valuations. We are trading at 41 times. Now, that is a big alarm bell, right? It's not amber, it's pretty red. And that is 60% above the average. So in terms of the actual valuations, we are very, very much in dangerous territory. But he's asking what kills bull markets. And this is where it gets more interesting. Historically, and I mentioned 1907, 1929, 1973 and 2000, what has killed the bull market every one of those times is a massive, a very large increase in interest rates. And we're just not seeing that. We're seeing a little bit more priced in, and you've been talking about what some of the banks have been talking about, maybe one, maybe two, maybe three hikes as well. But the fact of the matter is that isn't enough on its own to derail the bull market.
I was going to have a go at you for not using momentum being in the bear case, because the momentum argument kills the bear every time, and there's still a ton of momentum. We've seen it in terms of the tech names. But to pick up on the point around the earnings, I think it's quite cheeky to try and bundle it all together by the fund managers these days and talk about the valuations, because all the stocks in the basket are different. And just based on the earnings, we keep having a lot of fund managers saying, it's been driven by the earnings. So one is saying, look, if you look at the earnings, we're in complete overvalued territory. Others are saying the rally has been powered by the earnings are so good. And this is the point. If you're looking at some stocks, what are the earnings? They're coming up with entirely new business models that are completely changing the earnings overnight. So the valuation then changes overnight. I've seen a couple of stocks over the course of the last quarter where you're looking at it and suddenly it looks like it could be overvalued on every single metric. All the banks are saying, yeah, there's no argument that it is overvalued. But then the next minute, the earnings come through and they're changed because of all the excess revenue they're finding for something else they're doing in the data center. And suddenly they're not overvalued the next minute. So it's very hard to say it's overvalued when the metrics keep changing on the fly.
What if the ultimate customer doesn't make the money they think they're going to make? Because it's all being driven by this. But they're not. OpenAI, we think, may have delayed its IPO because they're worried about their financials.
Right, but if you think about the derivative of, which is the question you've been asking all quarter, what about the derivative of? That has been the semiconductor play. And the semiconductor play is saying, look, we see the demand for these chips. We're going to do 5-year contracts. And the customer, OpenAI and the like, they're going to be on the hook for these DRAMs. We'll meet the supply that they want.
What if they don't have the money?
Well, it's in a contract. And then you start going into the legalities and start suing, don't you?
You go into a different territory. If they don't have the money and they're committed to contracts, then you have to use an old term from the bond market, a reprofiling of the debt potentially.
Yeah.
And then, I don't know. I mean, I'm just saying, what if ultimately these large language model providers Sorry, you will get a word in edgeways.
No, I'm listening. I enjoy these chats. I really enjoy listening to them.
Oh, well, that's okay. You consider yourself a viewer. What happens if they don't make the money? What if the product becomes commodity? What if the Chinese, and I spoke to a very big tech entrepreneur last night, one of the biggest, and he says the Chinese are behind, but not far.
But what if they've got 5 years to make some sales? What if they have 5 years to make some profits? They have 5 years to meet some of those contracts. And that is the case if we're talking about 5-year contracts.
We're not talking about 5 years. It's going to take more than 5 years to put 1 million people on Mars.
But OpenAI is concerned about the next 6 months or so around coming to markets, whether the cash burn's too high. If we've got talking a 5-year time frame, maybe it can come up with the revenue model and the earnings to meet some of those expectations.
Yeah, I mean, the point about is this a situation where it then precedes a sharp correction, a downturn, as you mentioned the previous years, and the thing that you keep hearing is, well, this time it's different. But also, since I started the job here at the beginning of the year, the number of times...
How's it been? Has it felt longer than 6 months?
It's flown by. It's absolutely flown by when you're having fun.
You've got about 60 words in that time.
I know, if that's a generous estimate.
We've stopped you from doing that, me especially.
Hey, he's been a lucky charm for the markets. They've gone up in the 6 months.
Well, this is what I was about to say. You know, when I started, I had
lucky charms.
Some of the first guests we spoke to, since I started, we're talking about there was an anything but tech trade. There was a rotation away from the US to the rest of the world. And actually, what we've seen is that it has held up, and those things haven't come to pass. So I'm just intrigued as to what then happens in the next quarter and the second half of the year. Because everything, I don't know, the situation has been so unpredictable, and yet, the equities have held up and been so robust despite the war, despite the oil price fluctuations, and all there's still US policy uncertainty.
Well, why don't we ask one of the most important men in European business of the last 20 odd years in about 5 minutes some of these questions? I'll dangle that carrot for you, ladies and gentlemen. US envoys Steve Witkoff and Jared Kushner arrived in Doha on Tuesday, but direct talks with the Iranian officials appear off the table. Qatar's foreign ministry spokesperson said Witkoff and Kushner would meet with mediators, not Iranian officials, after Tehran said no talks with Washington envoys were planned. The yen, this is interesting as well, is trading at a 40-year low against the dollar this morning, well beyond levels that spurred the country's central bank into intervening a few months ago to shore up the currency. This amid hawkish Fed expectations. How hawkish? Oh my goodness me, we've got some programming for you later on as well. Nike shares were volatile in extended trade meanwhile. Despite topping earnings expectations, the sportswear giant reported a 12% drop in sales in its Greater China market, but still topped forecasts, whilst revenue in North America fell short of expectations. Ben.
We have got a busy show coming up for you, including this. The German government meets today to agree on tax and labour market reforms. We'll be joined by Aneta and Siemens Energy Chair Joe Kaiser after the break. Plus, our coverage from the Sintra Forum continues. The governor of the Bank of Latvia will be on the show later this hour. And don't miss our interview with the CEO of Tata Communications. That's coming up at 8:45 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. Germany's ruling coalition is set to hold a meeting today in an effort to agree on reforms, including on taxes and the labour market, whilst last week's agreement on pension reform provided a lift. Today's issues could prove more difficult to solve. Aneta joins us with more. And Aneta, you were speaking to the Bundesbank chief, of course, as well. And I was surprised, I was shocked that he was sounding so hawkish.
Well, actually, I think it is pretty much, not known, but he is always in the rather hawkish camp when it comes to interest rates, monetary policy. So I think it's for the Bundesbank, it's a big relief that the European Central Bank is departing from those unconventional measures and now concentrating mainly on interest rates. And of course, the Bundesbank and Germans have a tendency to be super much afraid of inflation. As we all know, that's down to our history, especially of the 20s in the last century when hyperinflation hit the country. And I think that's somewhat is baked into the national trauma set in a way. And that is why the Bundesbank very much is concerned about some entrenchment of inflation in the system. And that is also why the Bundesbank, and with that, Joachim Nagel is more or less a proponent of one more or two more rate hikes going forward, given the elevated prices. I think today it will be interesting to see when we get these aggregate numbers for inflation, and because that gives us perhaps more of a clue how urgent the problem seems to be for the ECB, whether they already will hike in July or only in September, or perhaps if they are not going to hike at all. That is an option as well, if inflation is coming down faster than expected. Of course, another topic to revive growth is high on the agenda here in Sintra as well. But of course, currently what's discussed in Berlin is, of course, pointing in the same direction. Today we are having the coalition meeting in the Chancellery starting at 1 o'clock German time, and it's crunch time for that reform package. We talk about pension, we talk about tax, but also labor market reform. And when I spoke with the Bundesbank president yesterday, I also asked him about the importance of that pension package, because here the progress seems to be actually the furthest in terms of agreeing between the two coalition partners. So let's take a listen of what he said.
Politicians are in the driver's seat. They have to do what is necessary to strengthen the economic situation in Europe, and especially in my country, the economic growth rates are not sufficient. I think for this year the Bundesbank is expecting 0.5, for next year maybe 0.0, and then for 2028 1.4. This is not enough. We can do much more, and these pension reforms are really a very important step forward to get into that direction that we see more economic growth.
So whether Europe or the Eurozone will actually make it into a more or higher growth path as well very much depends on what Germany, the biggest economy of the continent, is doing. And I'm very pleased to now be joined by Joe Kaiser, who is the chairman of Siemens Energy, and of course a commentator on widely political things as well in Germany. So thank you very much for joining us, Joe. So what do you think? Is it crunch time this week? How important is that reform package?
Well, obviously it's very important. There's massive relevance to the mood in Germany, but also to the structural improvement in the country for the economy. The only one thing I would caution is that we still talk about bits and pieces. We talk about pension, we talk about tax, labor. That's all very, very important. The only one thing I would caution is that I believe we need a comprehensive reform package so that everybody in the country is buying into it.
We've been talking about the need for reforms for many years. I remember it must have been 8 years ago that you told me it's all about execution, and now we're at the same place once again. So how confident are you that Berlin is actually having a higher alert level and that execution will happen?
Well, see, the challenge is always that, in Germany you've got 4 years as a period where the government can be active. The first year typically takes time to get to know each other, so to speak. Then there's 2 years left to get something executed. And then the fourth year is already campaigning again. So now this is I would say, the distinctive year for the German government to design and then to execute. But then again, I have to say, and we'll see what the outcome will be, they're addressing the right things now in terms of pension tax and labor. However, we need to have also an equity story for Germany. You know, the topic is about what's in for me. What is it that makes us work hard? What is it that drives everybody to go the extra mile? And this is missing, and that's why I'm a bit concerned that all those reforms, which are hopefully coming up the next days and weeks and months, that this is not enough, because a lot of people will be against it. They will be demonstrating, and this will again be then diluted. So that's my big concern. So I would urge the government, write an equity story, tell the people and the society what is necessary to get it done, and then move towards growth and a better country.
But Joe, good morning to you, my friend. The problem is bigger than just reforms of one individual country, and you know this better than anyone. I can't tell you how frustrated I am that the warnings from history, whether it's COVID, whether it's a war on our continent, whether it is the Trump assault on Europe and other partners as well, we get all these warnings, and yet when I speak to Christian, when I speak to other great leading CEOs in Europe as well, they say we're doing our business in the Middle East, or we're doing our business in the United States, or we are trying to do business in Europe, but there is too much in the way stopping us from having the same investment here as well. Joe, why is the mindset so slow?
Well, I could make it easy now and say this is the nature of democracy, but that's obviously, cutting it too short. And see, if you look at companies, enterprises, which have a structural need for reforms, big reforms, most of those countries take till the very last mile to go to the edge of the cliff. And then all of a sudden, the sense of urgency kicks in. The smarter ones, they restructure earlier, but the nature of governments, especially the coalition, which Chancellor Merz is in, doesn't make it easy. So that's why I'm really advocating for a comprehensive reform like Schröder did with his Agenda 2010. I believe we do need an Agenda 2030 or maybe 35, comprehensive equity story, and then also address the restructuring needs. And that's what we need to do. And see, Chancellor Merz, he's been in the industry. He's been working in the private sector. He's financially independent. He, in the end of the day, needs to lead that reform one way or the other. And this is still missing. And I hope at some point in time he comes to that point where he says, look, this is my agenda. This is what I stand for. This is what I'm going to do. People may not like it, but people will be remembered what they did for the country and not how long they were chancellor.
Joe, it feels to me as though Germany is just heading in the way of France. They're scrapping over very little money that is left. The big German package that was unfurled a number of months ago was meant to power growth. Of course, that was destroyed because of the Middle East conflict that drove up energy prices yet again. Isn't this the problem? There is just no growth again in Europe.
Well, yes. And people are debating on whether 0.2 or 0.5 is the right number for GDP growth. Both are rounding errors. If you think about the future of work, if AI, will boost productivity. So, this is the wrong discussion. The discussion is actually, what are the industries of the future? What is the future of work? How can we train our people that they are ready for the new sectors which will come into play? Germany and many companies too, they're still looking back. They're looking at steel, they're looking at the automotive, and they don't look what is the future of work and what's the future of industries. Germany, after all the, despite all the issues we have, the fact of the matter is we are still the third biggest economy in the world. So something must go right. And what goes right is that still many companies are globally very successful. And so this is, I believe, also a fact. But we do need massive structural reforms in also a sector which we haven't yet named and addressed, and that's what we would call as bureaucracy. It's very hard to do business in Germany. And I don't think we need a chainsaw to get things right. But this bureaucracy, the hurdles to do business in Germany is terrible. And so I would not just add pension, tax, and labor. This is also about, getting rid of, I would say, 30% of the current obstacles, which we would call bureaucracy.
Okay. Joe, it's Ben joining the conversation here. Obviously, there are some things that are down to German politicians and in the gift of Germany to sort and resolve to make investment and growth easier. But there are some factors that they can't control, and one of the biggest is the ECB's decisions. What do you make of the move to have raised interest rates, even though we've very quickly then seen the oil price come down? Some say the inflationary fears were overplayed, and of course that at a time when the forecast for German economic growth is just 0.5% for this year. That really does slam the brakes on any business trying to borrow to invest and grow, doesn't it?
It does, but I believe that, the ECB move, be it, 25 base points and maybe another 25 at some point, they are not the structural issue on its roots. It may not be helpful for growth, but, the real root cause for Germany going basically, traveling without moving, as you would say, is that there's so much hurdles to do business in Germany. The point is there is enough money to be invested. It's just more about the innovation pace and the hurdles and the issues which we have to get the business running. So this is I believe the main issue and the real big root cause why people don't invest in Germany. And you can see, if you look at the DAX, it's going from one all-time high to the next, because those are big companies. So they're going global and address the global growth markets. They bring some money back, of course, and create some tax substance here in the country, but that's not enough. So we need to focus on what industries are relevant for Germany's future, and we need to direct those resources to those industries.
Actually, Joe, that would be my next question because I think Germany is quite strong in all these future technologies, at least when it comes to the R&D work and also setting up companies. Just let's talk about space, but also, for example, fusion energy. How confident are you actually that this type of companies will be growing big enough that it can make up for the weakness of the traditional industries?
That's a good question. I would actually almost say it depends really on what industry we are talking about, and who we are up against in terms of global competition. If you look at China, for example, they've got 1.4 billion people, so their let's say the opportunity to scale up quickly is of course huge. If you look into the United States, that's the center of innovation for all the new technologies which we are talking about, from space to the physical AI platforms they are creating. So I believe we need to, of course, push those industries in Germany, but I would really, really recommend to have the Europeans come together and say, what is it that we want to play the future games and try to bring champions together, so that they can live up with the global competition such as China and the United States.